Hello and welcome to another episode of Nothing Ventured with me, Arish Shah. Today I was really excited to have with me Arthen Sirola-Hashemi. Arthen is an investor at Karma Ventures, a Baltic fund investing in deep technology. In today's episode, we talked about the transition from finance and operations into investing, what Arthen had to learn and indeed unlearn by making that transition. We talked about the state of venture in the Nordics and the Baltics. What are the things that are going well and what are the things that need to change, maybe to make the ecosystem a bit more inclusive? We finally ended up talking about the state of venture today. Arthen came into venture during the market downturn. What has changed? How many deals is he seeing? And what is his advice to founders looking to get funded? Let's get to it. Hello and welcome to this episode of Nothing Ventured with me, Arish Shah. Today I am really excited to have with me in the studio Arthen Sirola-Hashemi. Arthen is an investment manager with Karma Ventures, an early stage fund specialized in late seed to Series A deep technology ventures, creating innovative technology with commercial traction. Prior to joining Karma, Arthen worked on the operating side of venture, running finance and startups, ultimately as VP of Finance and VP of Strategic Projects at FitXR, an AR and VR fitness company. Arthen, welcome to the podcast. It's great to have you here with me today.
Great to be here.
Excellent. Look, for our audience, if you want to hear more about Arthen's background, how he moved from startups into venture, please do listen to the primer episode. But for now, let's dive straight in. We love, and I mean really love, an origin story here on Nothing Ventured. But I'm always even more interested when someone has made the move from kind of finance and ops into the investment side of venture. So what made you make the leap, and what were the skills that you were able to bring across with you to the world of investing? And more importantly, what did you have to unlearn or relearn when you moved from kind of operating into investing?
So, as in what made me make the move, I think whilst I was like in an operator position, the conversations I was having the most and the time I was learning the most was always when we were fundraising. Talking to people unearthed new ways to think about the business, new ways to think about the market. It required me to think more sort of strategically and to really get to full grips. It's very easy when you're in the day-to-day, you're constantly fighting fires. It's hard to kind of take your head out of the water and see, where you are. And I think that when I managed to get that breath and take a look at everything was when I was fundraising. And then I'm an economist. I enjoyed, diving into the deep side of what was driving different valuations, what was driving people to look at investing and at different stages. And I think also, to be frank, it's very taxing to work in Series A to sort of early stage startups. And, I could have done a few more and maybe done that same journey a few more times, but I'd much rather see many journeys with many amazing founders. I mean, I'm already meeting so many great people and hearing so many amazing stories than going much deeper on one individual topic. So I think it was more the energy that I was getting from talking to people, and then also finding it just a little bit more interesting. What I was spending my spare time on was looking deeper into the sort of VC side. And I think that made me realize, hey, maybe you should be doing that full time. Once I had a baby, I wanted to say, if I'm spending time away from her, I really want to be doing what I love doing. Yeah. And I think so far so good on that front.
Yeah. I mean, the interesting thing for me is, I work on the kind of CFO side of ventures, and most of the CFOs that I know who are really great are actually massive generalists, right? Mm-hmm. So CFOs aren't kind of your straight and narrow bookkeeper, accountant type people who go into practice or whatever. And I think, you know, what you said there really resonates in the sense that it's those conversations that, you know, pull on that thread that draw you deeper into exploring what the ecosystem looks like and how it, you know, how it can change and what else is happening, like completely resonates. And so what did you know, what skills that you had from working in startups were you able to kind of transfer across? And equally, you know, because operating is very much about being in the weeds, being, you know, a mile deep, whereas on the investment side, you kind of got to be a mile wide and an inch deep, right? You need to understand enough, but you need to understand enough about everything. Whereas when you're operating, you need to be very, very deep into what's going on in the business. So yeah, what did you have? What were you able to take across, and what did you have to relearn or unlearn?
So in terms of what I took across, I think like I was quite lucky with the founders who I worked with. So at TrueLayer, I had Francesco as CEO, was extremely strategic and a great sort of salesman CEO. I like to think of like the different facets of the CEO as operator, salesman, and product, i.e. like the kind of hands-on the business, selling the business to people, to customers, to VCs, and then really seeing the future of the product and seeing where it goes. And Far was just excelled so much at that salesman side. He taught me so much about the strategic elements of finance that it helped me be that strategic CFO, which you were talking about, and not go deep in the weeds, because coming out of Deloitte, that's all they have taught you is like, hey, this is the weeds.
You got this one thing, do that really bloody well.
You know, and that's what you're supposed to be doing there. That's not wrong at Deloitte. It's just that's what they teach you. And then Luca, the CTO there, we got along very well. So I spent a lot of time on projects with him, which maybe, you know, was more just spending time with him and learning about the business, but going deep on AWS costs and like how does that work and how do you actually manage that workload on AWS and like in a cost efficient way, balancing uptime versus cost. And I learned a lot about the ins and outs of how a startup runs beyond finance, which is very helpful to take across. Obviously, the base level of the finances is obviously a very useful skill, but it's the kind of wider spectrum which helps.
Yeah, how do you think about finance in terms of headcount? How do you think about finance in terms of geographical growth versus product growth versus whatever else? Right?
And I think it gives like a good sense of empathy for different situations. Like I've been in similar ones, helped in some, seen some others, and it's, as a VC, given me a healthy sense of perspective of, okay, this may seem really bad from the outside, but I've seen it, you've overcome it, and it's okay. And I think it's only 2% of VCs in Europe have an operator background, and I think 20% are ex-founders. So there's very few VCs, especially at kind of mid-level, which I'm sort of operate at as an investment manager, who have been and seen that. They've seen loads and loads of cases. They probably have a much broader perspective of versus other companies, how it feels, but much less on the kind of individual.
Not having actually been in.
Yeah, how it feels to be in that situation. I remember like, you know, an incident at TrueLayer and like everyone pulling in and helping, and the kind of, it at the time seemed like a giant sort of problem. And then in retrospect, it was very much solvable, but
it's like, how do you invest in a startup if you don't know what it means not to be able to make payroll next month, kind of thing,
100%,
right? Like
100% that. And then going on to fintech, I had Sam Cole, their CEO, was such a good operator CEO in terms of like understanding the people and making sure that the trains were running on time and like getting everything really efficient and running. And he taught me a lot about how to run a business on the inside, as well as like how to kind of scale in my role and understand. And I think all of them I had quite a good relationship with, so it was very healthy for me to be able to say, hey, like I really need to upskill here. I don't know what I'm doing in this regard, or do know what I'm doing here, because it was, you know, I didn't work any in-house finance before I joined TrueLayer. I learned all of that on the fly. I was putting the like train tracks in front of the train as I was learning, and I had a pretty healthy sort of like cohort of both peers and founders to work with to say, hey, like it's okay, take the time, figure this out. And like I could then be honest about I mean, we were all figuring out as we were going. None of us had done.
I was going to say, I mean, most startups is like everyone just throwing lots of shit at the wall and trying to figure out like which one's going to work.
Yeah. So to bring it back to your original question, sorry, I went on a bit.
No, that's cool.
There. But so the finance side, and then the kind of knowledge of what I could bring across, and then on the what I had to unlearn side, you talk to 6,000 companies, let's say, over the course of a fund, probably more. Just pulling a number out of the air. And then I invest in 4 per year as a fund, not even as an individual, as a fund. So getting emotionally attached to people you're talking to, and like to amazing founders or amazing products, which maybe don't fit our investment thesis, or maybe kind of are really good, but just not quite for us, like the round doesn't make sense. It was something I had to unlearn. And I think, one of the really good pieces of feedback I got early on at Karma was to not use the word like convince internally, because we make decisions as a team just to present the facts, and not like my job isn't to convince the team that this is a good like deal to make. It's that if it's the right deal, it will go through, and your job is to kind of find and sort of poke and prod and like understand fully and then present the full picture. But it puts you in the emotional mindset much better, where if you're not, your job isn't to get the deal done, it's just to find the right one. And that was something which I had to unlearn, because I very much, A, went deep in a lot of things, and B, really enjoyed like talking and working with new people and founders. It was something which didn't come very naturally, but like with that feedback and that early, because of nipping it in the bud, when the first sort of deal you get excited about doesn't go through, you're in a much better mindset of, oh, okay, like this is a long game, it's not, everything's not going to work all the time. And I think the lack of KPIs and the lack of targeted goals is the other one, which coming from startups where like everything is so like just knocking out whatever's on fire, putting out fires, you get that kind of inherent, at least that's done. Whereas you never get that here. It's just a constant stream of meeting people, and it like something may come out of meeting the right person in 2 years' time or not, but you'll never know. And you'll never know if the deals you're making are the right one until the end of the fund life cycle.
15 years on or 10 years on or whatever.
So that element of just not having anything to benchmark performance off of, especially as a finance person, where you're constantly like benchmarking KPIs against different external factors, that came quite difficult.
I was going to say, I mean, like, that I can completely understand. The other bit that I struggle with when I'm looking at angel investing as an example is, as a finance person, it's really easy to look at the numbers and look at the business and find every reason that it won't work. Because that's essentially what we're trained to do. It's like, okay, this is how a business works. But at early stage, no business looks like it's necessarily going to work, right? You've got to be able to step back and say, what does this look like in 5 years, in 10 years, right? Like, is this going to be a behemoth? Is it going to go through massive growth, and is it going to be a category change, or is it going to create a new market or whatever? And often at very early stage, like all ventures look like they're going to fall over, right? So I wonder, how do you circle that square? Like, do you find yourself not looking at kind of the financials of the business in too much detail, because they actually can act almost as a red herring? There's something maybe to just diligence at the end rather than get deep into, or how do you think about that?
I think it's been helpful for me to work first in open banking before open banking legislation was even enacted, and then B, to work in virtual reality when there weren't many headsets. And like in both markets, we were building something I really believed in technology-wise.
Got it.
And really thought this was like the future, and it was just, will the market catch up in time? Will the market time it right? And I think that's helped a lot for focusing more on the market and the technology, and then using like just a minimum for the finance, or like, does it meet like the criteria of like, okay, can a round here make sense at the levels which Karma operates in, both on the up and down side, and does it fit the thesis? Like, does the are they building something technologically innovative here? And how, like, can you see that going places in the future, being the kind of main core part of the thesis, and having technical advisors helps on that side.
Yeah, and I guess with a deep tech fund, it is more about the technology in any case. And to your point, I've worked with businesses, or we work with businesses that are very R&D heavy. They may spend 5-7 years building out the technology before they even look to go commercial. So to your earlier point, like, you don't have a benchmark for what it's going to look like. It's only once, the rubber hits the road where you find out whether there is a commercialization opportunity. And indeed, the product may actually pivot in terms of customer base when they find work. Actually, we built it for this customer, but actually it makes sense for this completely crazy customer over on the side, and then the whole product kind of moves as a result. Moving on from that a little bit, look, we talked in the primer about or you mentioned certainly in the primer, like Nokia, Skype, right? And I think a lot of us forget that there's been some incredible tech that's come out of the Nordics. We were talking about the Oura Ring, as I mentioned, Nokia, Skype, but you've had Spotify, you've had various others. But I would hazard a guess that most of our audience will have limited experience of the venture ecosystem as a whole in the Nordics and the Balkans.
Yeah.
How would you describe it, and what does it offer that other regions might not? And I guess, are there areas where it can improve or grow on top of that? Or, how do you look at the whole ecosystem out there?
So do you want me to focus more on the VC side of things, or more like the venture ecosystem, or the startup ecosystem, or both?
I guess a bit of both, yeah.
Okay, so I guess to characterize it, it's very much like each country typically has its own set of like early stage VCs who only operate in that country. Mm-hmm. So people like Lifeline Ventures in Finland, or you'll have, say, like Trind, who like a lot of them operate within the Baltics and Nordics across borders, but they operate within just that ecosystem. Which, coming from London, a lot of the early stage companies invest across Europe,
Pan-Europe,
even like pre-seed or seed. They don't limit themselves by geography; they do more by industry, and so it is much more geographically based VCs than industry specific. And then there are the kind of a few who invest across Europe, or like ourselves at the kind of bridging to growth stage. So pre-seed and seed, sort of geographically locked, and then there are some who kind of bridge the gap to Europe, and then at Series B onwards, you get your kind of large funds who come in and just kind of pick the best of the bunch, so to speak, as I think probably they like to think. And then that's kind of how the VC side of it works. And you'll see that a lot of local events, where if it's a slightly more local event, it's the same people at a lot of the events. And I'm already beginning to be like, okay, it's people from, various different funds in the Nordics. And that's typically Nordics and Baltics. That's how it works. And then on the startup side, you have like some specialisms in industries. So, Finland has great quantum computing companies, and obviously, has a hardware specialism from the Nokia kind of era. Yeah. And then you have a lot of sort of great technology companies coming out of Estonia, Lithuania, and Latvia in different specialisms. So Bolt came out of Estonia, TransferWise, Skype, and then those kind of, I hate the mafia term, but like those set of early employees go on to found their own startups from what they've learned. And then, but one thing, so you have is that there's kind of a much more heavy starting local and expanding geographically, compared to, I think, in the UK, I think it's partially language based, and also just the links to other countries are so big in the UK that people start much more globally straight from the off, or with the intention to go globally straight from the off.
I mean, one of the things that struck me as you were talking there is a lot of the businesses from these regions are quite software heavy, right? Yeah. They're tech companies, and we all know that obviously, in countries like Estonia and other regions in the Balkans, there is a heavy, you think about Ukraine.
Correct. It's Baltics.
Sorry, not Balkans.
Yeah,
sorry, my mistake.
Don't want it to,
I think I might have got that wrong earlier, but anyway, we'll see if we can scrub that out. But in the Baltics and the Nordics, there seems a very heavy kind of software focus, tech focus, and you see that Estonia, Lithuania, Ukraine, etc., having very strong software infrastructure and teams in place, right? Unlike, let's say, the UK, US, etc., where there are lots of product-based kind of startup scale-up. So you think, you think about, I don't know, companies like Gymshark or THG or anything that is sort of on the e-commerce side of things.
Yeah.
Whereas it feels like the startups that are coming out of these regions are heavily into kind of the software or fintech or deep learning or even hardware kind of technologies. Would that be a fair comment, or is that just because those are the ones that we hear about?
I think probably those are the ones you hear, like an element of those are the ones you hear about. I'm not sure if someone in maybe Estonia knows what Gymshark is. I mean, probably if they go to the gym all the time, they might, but like as a brand, it's probably less proficient. And then also I think it's a case of it being much easier to expand geographically with software.
Yeah.
So, Estonia as a market is relatively small. I think total people is 1 million, 2 million in the country. So it's not its own market. So it has to expand. And expanding with software is so much easier than expanding with like physical goods. I think it's also a little bit of the culture. I think the culture in at least in Finland is much more towards sustainability, paying once for something of very high quality which lasts for a whole life, and the design of the products it very much matches that. Finland's a very design product orientated country, so I think that plays into it as well, where the brands that you do get out of there are very much high-end design brands which then make their way over and probably aren't in as much common parlance as the kind of mainstream brands which everyone would have something of.
Yeah, no, that makes sense. And where do you think that there is sort of room for improvement or growth within the ecosystem?
Definitely diversity. I think it's a very undiverse ecosystem, and I think a lot of the VCs is reflected in a lot of the VCs. There's very few people coming from London. People come from all over, start their work in London. Both of the startups I worked at, the co-founders were not from the UK.
They're migrants, yeah.
And it's 50% of UK unicorns are founded by migrants and immigrants. In Finland, of the top 50 companies, 6 have any non-Finnish co-founders, and I think only 2 or 3, and this is just from high-level Crunchbase search myself, so take it with a pinch of salt, only 2 or 3 had no Finnish founders at all. So there's very much not this, the people who go and work at tech companies in these areas either can't find funding locally at the early stage, or they move to London or other kind of ecosystems to build their companies. So I think on that side is one, and then local sort of immigration rules and things is a common topic in Finland of how can we get more talent in. And because they don't have this long history of kind of people immigrating like the UK does, there's a kind of this attitude that all migration is immigration or refugee status, and so it's a very aggressively kind of policed. Yeah. The question in my, I have a Finnish wife, and the question in my kind of application process was, why do you need to be based in Finland to do this job? And I was applying under a specialist visa for access, a quick route in, and the default is you shouldn't be here, if that makes sense. And so
so there are more reasons, or the applications are based to weed out rather than weed in.
Yeah, exactly. Yeah. So I mean, the UK is very good at this and kind of shot themselves in the foot recently, obviously with the talent visa debacle. But
and Brexit.
And Brexit.
Forget about Brexit.
Yeah. Okay, I'm too recent on my shooting. We've shot ourselves in the foot many times, so I need to be more specific. But yeah, there's a lot more of a welcoming of international talent, both with funding to start their own thing as well as to get it into fund British businesses.
Yeah, I think in my mind there's this virtuous circle of where there's capital, there's talent. Where there's talent, there's capital. All right, so you need both of those things, and it's the usual marketplace kind of problem. Which side of that market do you solve first? So I would assume if Finland was to bring in, and very clearly, it is a wealthy nation, right? Like, so if they were to start programs of funding more innovative startups with a view to attracting more talent, they would. But the question is whether or not they actually want to attract that talent, right?
And I do think a lot of VCs bring network of talented people who they will fund. So if you bring in diversity in your venture ecosystem, then that will attract founders who say, I hadn't thought about starting a company. And Estonia does this very well, of bringing founders in to start companies by making it very easy for them to start companies. And so they have regulatory as the first step, and then venture has helped with that, because the venture ecosystem's been very accepting of foreign founders in Estonia, but it helps that Estonia is a very small market, and they've had large amount of tech success, so they're very pro tech companies. I think in the kind of wider Nordics, I mean, Norway, for example, has so much sovereign wealth that I think they're less inclined to.
They're not worried.
They're not worried about the state of their economy. They're not trying to build as many of these tech companies as they can to fund GDP growth, whereas Estonia is embracing it in things like digital identity and other areas of digitalizing their whole economy. But they only became a state in the 90s. So they started at a much more recent time and could embrace technology as it came out. So I think a lot more of the sort of governments need to detrench their ideas from how things were done and embrace new technology. Finland does that as well with bank IDs. So you use your bank account as an ID for various different government portals, or instead of using your passport, you can use your bank account. But it does make it harder for people coming into the ecosystems.
Yeah, which tends to be the problem for a lot of migrants, irrespective of where they are, right? It's that whole access to ID, and therefore what services you're actually able to avail yourself of. Interestingly, a friend of mine who I kind of recently reconnected with, I went to school with 25 years ago, whatever it is now. His name's Isaac. He was actually CMO at Nosto, and I think and has been based out of Helsinki for the last 20 years. And I actually asked him, I expected you to go to Japan. He's of Jewish heritage, but had a love for kind of Japan and the Japanese language. And he said, I haven't actually been back there for 20 years, but I love it here. It's beautiful. There's so much work-life balance. The countryside is amazing, et cetera, et cetera. And I think these are the things that are both attractions, but also for the local population are deterrents for net migration, right? Because what you want to do is preserve that idyllic kind of landscape, if you like, or living condition. And then it's how do you strike that balance? Whereas London, as you say, has been a melting pot for millennia, right? So whilst we have various voices saying too many migrants, etc., ultimately this country was built on migration from various places,
and that's mostly not mostly outside of London,
correct?
Outside of the actual melting pot, side of it. The more diversity you have in an area, the less the attitude towards migration is poor. But just to go back to the startup ecosystem in those countries, talking about the quality of life, one thing which the area does very well in both Baltics and Nordics is public funding, both for quality of life parts that makes us all good, but also for the startups in the ecosystem, which means that it's much easier to get your startup up and running with sort of grants and loans and various bits and pieces. But it also means that there's less hunger, both from the quality of life and in that there's availability of money to extend your runway, try and find product market fit, which should in theory help. But a lot of the time, in the UK and especially in the US, it's much more kind of Spartan. Only you either find
only the fittest will survive.
Only the fittest will survive, and so you find a lot of companies who maybe they don't make the right product market fit decision. They don't make
because they can fund themselves.
Because they can fund themselves in other ways, and then they never get. There's also an attitude that this is enough, which I think doesn't exist as much in the UK.
Yeah.
So it's that kind of public funding and the kind of national identity of this is enough that maybe means that there's a lot more like very strong companies, like with great product, with a great sort of product market fit, but who don't scale as quickly as they could because they don't need to.
Yeah.
And then it's just an interesting, I think, in my mind, sort of.
So it's that question of, because I talk about this a lot, right? It's that question of how much you raise, enough to keep going, but not so much that it makes you lazy.
Yeah.
Or makes your balance sheet lazy. And it sounds like what you're describing is essentially access to capital allows businesses to coast, right? So they don't need to be innovative necessarily or growth hungry in order to grow, raise more capital, scale, etc., because they can actually survive with the funding that's out there. And whilst over here in the UK, as an example, really your only avenue to early stage funding is really via the SEIS and EIS kind of programs, which are the tax efficient programs that are run by the government HMRC, because grants are really hard to apply for and be granted. And there are fewer kind of very early stage venture funds that will fund an idea, right? Like, so the first capital that you're going to get in the UK is friends, family, and then maybe some angels thereafter before by the time you're talking to VCs, you're probably already at product market fit, right? Whereas it sounds like in the Baltics and Nordics, you can essentially get there with the benefit of the various sort of funding programs that are out there, rather than having to kind of hunt around for additional capital.
Yeah, and it does help with things like deep tech companies, because before the company's founded, you have this long period of public funding, and it helps in various other ways, and probably in the current market will mean that it's a very good thing to have for startups being able to continue and bridge the gap towards a kind of more positive venture market. But then it comes with, like, if it's what should be a venture funded company, like going with grants leads to the wrong product decisions because you're not going for that hyperscale growth. Yeah,
well, that's interesting because that's a great segue into my next question. Actually,
I teed you up very nicely.
Well done. That's good. No, but look, you got into venture at a time where the whole ecosystem has basically slowed down. It's tightening up. It's shrinking. What impact has that had in terms of the quality and volume of deals across your table? And what advice would you give to founders that are looking to raise at the moment? And I guess maybe if you talk it specifically in terms of Karma and kind of the deep tech ecosystem.
So, I mean, a little bit interestingly, because of how people talk about it as VCs not making deals. But I think currently we're also seeing a lot of companies just waiting things out, where if they have the runway, they're trying to stretch that as far as they possibly can before they go and raise. So I think it's not a case of like there's all of these amazing companies out there that's like trying to fundraise and VCs not funding them. I think people are fundraising when they need to and not when they want to, which I think before was a lot more strategic around whether people were sort of in a hype cycle or not to whether to raise. So I think in the generative AI space and in the AI space generally, it's moving out of deep tech and into mainstream, which means that deep tech investors and like generalist investors all want in on the space, which is always dangerous. I think I was looking at a chart of the average valuations of Series A and onwards generative AI companies, and it was in the magnitude of 40% higher than the average Series A, and that's always like a little bit alarming to see as an investor. But I think it's calm on both sides, and it will really be depending on when the market recovers. Does it recover on the investor side or on the startup side? You'll begin to see more of what does this actually look like in the near future, because I think at the moment everyone's just kind of
holding pattern.
Figuring it out on both sides of the market, and then there are occasionally great companies who need to raise, and then they're getting deals done, and then companies who are maybe forced into raising in a position where they're not ready are struggling to raise at the moment. And I think Series B onwards is pretty much dead. It's down like 50%. European deep tech deal flow below Series B is down 15%. So it's not as drastic. It's a pretty big drop, but it's about at 2017 levels. But it's really that growth stage which is not seeing anything. And what was before, like if you had 5 million ARR and had X level growth, it was just find the right investor who doesn't have you like a competitor in the portfolio. I think right now it's much more difficult to raise. There's no playbook for fundraising. I was going to do a talk at a conference and I had done like fundraising playbook because as a CFO it was very useful to have things to benchmark against to know what good looked like. And I got a great piece of advice from Nordics, one of our partners, was saying like there is no playbook in like even in the best market there's no playbook, but there's definitely no playbook now.
Yeah, the SaaS napkin is a guide. It's not a playbook.
Exactly. Is it like playbook's the wrong word here because it doesn't. There's no way to guarantee funding. There's no steps you can take.
The way I always talk about it with founders is that you don't set your price. Your price is negotiated. It is whatever a buyer is willing to pay for your business. Essentially,
100%.
Right. And actually, it's interesting you said that because I mean my both anecdotal and slightly data kind of led. Understanding of where the market is and where it's likely to go is we have a whole swathe of businesses that raised capital in 2021 who've extended runway out till now, will be going out to fundraise over the next 6-12 months, but in my opinion have probably raised at too high valuations when they raised in 21, haven't hit the sort of traction metrics that they need to, and those are the guys that are going to struggle. They may be good businesses, they may even be great businesses, but the cap table's already screwed, or screwed up rather. And I was talking to we had Egosa Omogui on the podcast last week, and he also invests in deep tech, Echo VC, and we were talking through a deal which came across my table, which is picks and shovels on the AI side, and the founder was trying to raise at a 10 million valuation on 30 MRR, so 300 ARR essentially, right? Because he'd been able to raise in 2021 on pretty decent valuations back in those days. And it goes to turn around and goes, look, we just did a deal. Company's doing 4 million top line and it got priced at 25 million, right? Yeah. So we're talking 5 to 6x, not 10 to 20x. So, he actually said, I'd be surprised if this guy can raise at a 3 million valuation today. That would be really punchy. So there is no playbook, right? I think it is what you are able to achieve and what you're able to kind of not even command, what you're able to negotiate, right? And when the funding market was exuberant and there was cash everywhere, negotiation was still possible. At the moment, not that many VCs would ever come out and say this. Some of them may have had LPs that have basically, said, can you delay that capital call, right? Or if this happens, we won't be able to invest in the next fund. Or, people are starting to see the DPI numbers or the TVPI numbers, and they're starting to think whether their allocations into venture makes sense anymore in a high interest rate environment. So VCs are also thinking about, well, am I going to have is there going to be another fund after this one? Do I slow down my roll? Do I actually kind of sit back, wait for some of the blood to clear, and then start deploying again? I think, to your point though, I think VCs are still deploying, absolutely, but it is no longer the case of every deal can get funded. I think it's we've gone back to if it is a good deal, it will get funded, right? And if and if it makes sense, but if it doesn't, then
people are just taking their time and like getting a lot more comfortable with deals. And I think on deep tech, one of the good things and bad things about deep tech is there's a fundamental acquirability of the tech. It's an improvement on what's out there at the market. So even if commercially you're not successful, there are exit opportunities. There's exit opportunities at a good value, decent value for that technology. And so the kind of floor is a lot higher. It's much more difficult to go to zero. On the other side, you have much longer sales cycles and higher ACVs because you have this technology, which is people spend a long time building and is much better than markets, but you have to convince people of that. So it's much more difficult to grow as quickly. So it's kind of in the hype times, it's much more difficult to get crazy valuations because it's much more difficult to just pump capital into a system and get it to return at the same sort of short time frame because of the long sales cycles. But on the other side, now that things are bad, DPI numbers are much higher because there's the fundamental acquirability, and you never had those crazy valuations because it's a much slower business. It doesn't work that way. So in that side, coming into it,
unless you're OpenAI, of course.
Of course, like if you're a non-profit who pivots later into, like, I think their journey is just very non-traditional.
Yeah, atypical to say the least.
Yeah, but coming into it in like you said, like coming into it in a much quieter time when things were so crazy over the last few years, I think it's much more helpful to be in a deep tech space where a lot of like deep tech is moving out. So deep tech gets funded in bull markets. People have a lot more cash to put into R&D to make the technology, and it actually aligns pretty well with market downturns of things going really big. So you have, 2007 global financial crisis was also when the iPhone was released. Like 1981, the first PC. There's like a big recession in the 1980s. So every sort of 13 years, and like this is a very much an Arthen.
This is this is the Economist.
This is the Economist coming out with like a very loose model, which I haven't proven with so much data. But you can kind of trace from like microprocessors in 1955. Every 13 years, you get like a recession, and then like with what is being funded
a platform technology,
and then that gains traction over the next few years during the downturn, and then pushes a large period of growth after it, at least in the tech sector. So obviously, like whole market aside, but internet drove .com bubble, and then like into all of the developments which went into the iPhone, and then, which like in 2007, and then before that you had the PC, and before that you had microprocessors and semiconductors, and before that you had mainframes. So it's like this constant like evolution and things moving from deep tech into mainstream. And so we're now at that time.
Well, we're about 13 years on from 2008. So
2020. And like, I used to, when I was in VR, I used to say, hey, 2020 is when the Quest 2 came, which was kind of the main, it was called Quest 1, and then 2022 was the Quest 2. Obviously, if you had spoken to anyone during that time frame, they would have said it's Web 3. Then now it's looking like that's, 2020 was GPT-3, I think. And then obviously that's kind of aligns with that 13-year time frame again. And it does sort of align pretty like, loosely to this.
You should trademark it for sure. Or you should.
I think like
you should. Or
you're patting me on the back a little bit too much. I think this is very much Arthen's sort of tinfoil hat mad ramblings.
I mean, at the very least, you should get out a napkin, draw it, and post it on LinkedIn, because you'll get a lot of likes on that. No, look, and the reality is, the businesses, the euphoria within the businesses that are building on top of ChatGPT and so on and OpenAI, is very much there. But I can see once all of the kind of noise dies down and lots of stuff shakes out, the transformational nature of that as a platform, because it essentially it does two things, right? So it enhances search, right? So if you think about search, then it basically becomes, the next paradigm in search. But it also essentially lowers the cost for development so 100%. Substantially that you can now spin up software companies at a much. So there's a question as to what does that then mean for the VC market? Yeah. Because if you're a non-technical founder, as I am, and you can essentially build something, off the back of the envelope using OpenAI, then how much need is there for that early stage capital? And the other thing that I think that is, really interesting is I think there's going to be an unbundling of some of the deeper tech businesses, or some of the tech businesses, rather, I should say, as a result of what's happening, because you now have, not only the ability for founders to spin up a new business from scratch, but they can look at their existing business and say, well, I'm buying in 30 different things from 20 different providers, and actually I could spin up my own microservice for these 6 essential needs, and therefore cull that kind of external software provision by 20% or whatever. And I think we'll see a lot more of that happening as well. So I agree. I mean, like, whether it's because of the 13-year time cycle or not, I definitely can see that we're in a platform shift kind of period. And it is exciting. And I think, I think that there are definitely challenges, and I think there are definitely concerns, right? As we know, but it's, it's during these sort of periods where really great things can happen.
Yeah.
But look, Arthen, it's been absolutely wonderful having you here with me in the studio
It's been
today.
great to be here.
For our listeners and our audience, where's the best place for them to find you? You're online, you're on LinkedIn, Twitter. Where can they look for you?
LinkedIn, Arthen Sirola-Hashemi, and then Arthen SH on Twitter. I used to be more active. I will probably start doing it now.
Well, you're
I'm
a VC.
I have to go on Twitter, and I have to. I think I want to get onto the VCs congratulating themselves Twitter page, or a similar shameless VC page.
That's your KPI.
If I have to set my own KPIs now because I don't have any, then I'll use something like that as a good barometer of whether I'm doing it. I don't have a Patagonia vest yet. I don't have a pair of Allbirds. That's probably a bit of an outdated meme now. I don't know. I've heard there's a new Patagonia vest which everyone's wearing, but I don't know what it is.
I haven't come across it. I'm going to some VC drinks on Thursday. I will take some photos and let you know. But look, Arthen, it's been wonderful having you here. Thank you so much for joining me.
Thanks.